The trend will not change until central banks stop buying gold, and they're not doing that. And this is just a breather. You also have the October sell season where it's the end of the fiscal calendar. You got hedge funds need to balance their books and book their losses or their gains. You have November being the buy season, where now they come in with fresh capital and getting ready to redeploy it. So there's a lot at play here. But in the end, who benefits? The ones that were able to drive the price down.
The thing that's fascinating is that while traders would have done that perhaps in futures and perhaps also in Shanghai, you still had a backwardation between London and COMEX. Mm-hmm. And if you look at the volumes in the silver contract on COMEX, I mean, it's just gone to a crawl. They're not dealing, basically. So nothing has been resolved. You've still got the problems there.
Walk into the London bullion market today and you'll find a strange silence. Almost no liquidity left according to Alasdair Macleod. The usual churn of silver trading has dried up partly because the latest price shakeout scared away retail ETF buyers. That's more important than it sounds. Most of the silver stored in London vaults exists to back those ETFs. When investors stop buying shares, new metal stops flowing in. But when that demand inevitably returns, it will slam into a market already starved for supply. Macleod says physical demand tells a very different story. Dealers everywhere are still buried in orders for coins and small bars. The Perth Mint is sold out. US and European wholesalers are struggling to restock. There's tightness at every level of the chain. Big institutional players are betting this wave of enthusiasm will fade like it has after past silver spikes. Drive prices up, crush them back down, and wait for sentiment to die off. But this time the short positions are under growing stress and time isn't on their side. For traders, that setup means turbulence. For long-term stackers, it's a gift. Lower prices let you accumulate more ounces while the system buckles. The real mistake, Macleod warns, is selling into weakness and missing the rebound. Silver stacking isn't about timing a rally, it's about insulating yourself from a monetary system built on debt and credit. Gold and silver aren't rising because they've changed. They're rising because everything else the paper promises we call money is quietly losing its worth. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
There is no liquidity in London. If the shakeout has discouraged ordinary people from going in and buying ETFs, which is a real problem because, the ETFs basically, if you look at what's stored in the London vaults, it's almost all ETFs. So if you get subscribers going in for silver ETFs, then, the problem is going to come back in spades. So, it's still there. And I don't think what we have seen has really discouraged the retail market, if you like. I mean, everybody I talk to around the world, they're still incredibly busy dealing in coins, small bars, and all the rest of it. The public are still buying this. I think there's a bit more two-way trade, yeah. But, the Perth Mint has got nothing. It's sold out.
Yep.
And this is a story I'm hearing all over the place. So there is tightness in these markets. Now, I think the hope is that you can just sort of sit on it for a little bit. Then, the enthusiasm will go away. This has happened before when we saw the spike in silver. Was it back in, can't remember when it was. It was not all that long ago, a few years back. The enthusiasm went away because they just basically ran up the price and then bashed it. Which is roughly what, that's a standard tactic. How long this consolidation is going to last is difficult to say. But, the clock is ticking on the shorts. That is really the problem. And if you're a trader, then good luck to you. You got your life in your own hands. That's not what we're talking about. If, on the other hand, you're a stacker, then you say, hallelujah, I can buy some stuff a little bit cheaper than I thought I could yesterday. And that's the right attitude to take. Just keep stacking. I mean, we've seen it before. You sort of see price run up and then it comes down and all the rest of it. And everybody says, it was overbought and stuff. So they stop buying and then it runs away. And suddenly they find that what they sold, say at $2,700, or $2,070, which is where it consolidated after COVID. They're out of the market, and here we are close to 4,000. Help, what do I do? I mean, idiots. You've stacked for a reason. You're getting out of credit. That's the whole thing. It's not gold going up. It's the dollar and all the other fiat currencies going down. And we can now see the path to their complete destruction. That is the key thing. This is not a time to accumulate wealth. It's a time basically to secure what you've got. And that means getting the hell out of credit. There is another aspect to this, which I think is a hidden. Earlier this year, we found, much to our amazement, that bullion was being taken out of the Bank of England's vaults and shipped over to COMEX to benefit from the arbitrage, as it were. The arbitrage was the other way. London was below COMEX. COMEX, huge great premium. Why? Because of uncertainty of whether gold will be tariffed or whatever. So, but the thing about it is that certainly commercial entities do not store very much gold in the Bank of England. It is mostly, and when I say mostly, not quite entirely, but because we don't really have the true figures, it is other central banks. What will have gone out is leased gold. Now put yourself in the shoes of a central bank using the facilities of the Bank of England, which until now you felt quite confident because you lease your gold. Basically, it pays for the storage costs, and also you get a bit of a margin on top, which means that you've got this sterile asset which is actually earning you something, which is great. You have the comfort that the Bank of England is going to continue to store that gold over the life of the lease. All that's happening is that there is a book entry transfer system. The bullion's got to remain in a vault, for goodness sake. So it may as well remain in the Bank of England's vault. So as a foreign central bank, you're sitting there quite comfortably. You know, at the end of the lease period, you haven't lost control over the gold. Looking at it from the point of view of the foreign central bank, you've lost control over it. Are you going to get it back? You don't know. What you are likely to do, however, is to take the view that you're going to exit this leasing game. There's no point, because if you can't secure your asset, why lease it?
Andy Schectman, CEO of Miles Franklin, points out something unusual happening in the metals markets. Typically, traders who want physical delivery of gold or silver declare it at the start of the delivery month, October 1st, for example. But this time, both markets saw a surge in mid-month delivery requests long after that window should have closed. Silver deliveries jumped nearly 200% after day one, and gold deliveries rose about 90%. In other words, while prices were being pushed lower, a wave of buyers suddenly decided they wanted real metal, not paper promises. Schectman explains how this works. Large players use futures contracts on later delivery months, like December, to push down the spot price. Once the price falls, they buy current month contracts for immediate delivery, securing physical gold and silver at a discount. It's a sophisticated maneuver that hides real demand, since analysts usually track only first-day delivery data. Between October 17th and 19th, over 6,000 new gold contracts were created for instant delivery, an all-time high for that stage in the month. Schectman says it looks like short sellers are scrambling to cover, and the timing is suspicious. With the U.S. government shutdown in effect, regulators like the CFTC weren't even watching. Let's get back to the interview.
What's really interesting about it is that both gold and silver experience massive mid-delivery month deliveries, issuance. So what I mean by that is that most people who stand for delivery make the intention known on day one of the delivery period, like October 1st. But what we saw in silver, the deliveries are up 193% from the first day notice number. This showing a rush for physical metal as they drive the paper price down using the December contract, and then come in and buy October immediate delivery contracts late in the cycle, which makes it tough to analyze because, most people are looking at the open interest and then try and discern who's going to stand for delivery on day one. Well, these guys come in, knock the paper price down, and come in the middle of the delivery period and buy a contract for immediate delivery. Same thing is true with gold, up 93%. from first day notices. And it's a big deal because, you've had 6,000 between October 17th and 19th, I believe the 3 days, over 6,000 contracts were written for immediate physical delivery. Each of those were daily records for this point or that point in the delivery period. And so, you're looking at a situation where entities, to cover shorts, are driving paper prices down to buy immediate delivery contracts for the current month. All of this is happening, and one could argue is collusive, is in I'm sure, violation of several laws that the CFTC should be policing. Yet, of course, they're on vacation right now as government is shut down. And it certainly has the footprints of big banks, not only covering shorts, but also big players that are being squeezed out of positions, covering, taking profit. A lot of the things that the public or that the mainstream media would have espoused are valid and true. It was extended, had gone up for 9 straight weeks. It was overbought. But when you see, as an example, last week, a market where after New York had closed and on its way to Asia, there's virtually no liquidity. The traders in New York are done for the day. The traders in Asia are not at their desks. And someone comes and pours billions of dollars of gold and silver on the market. Now, that would guarantee you the least beneficial settlement you could ever possibly get. It would just trigger sell stops all the way down, and you'd get algorithms that would sell as these levels are being violated. There's no one there to catch the bid because there's no liquidity in the market. It would guarantee the worst possible settlement. It was done for effect, and that's when Bank of America and Morgan Stanley came in and bought massive amounts of physical and pushed the price back up like you saw here today. Price goes down and then comes right back up. It reeks of short covering by large players who have too big of a position, these 4 or 8 Western banks, where the spike in gold that we saw in silver was creating borderline existential threat to some of these players, and this is the reaction that we should see. I think that's the point, is that the mainstream media talks about the reasons, many of which are valid, but they neglect to notice that part of the way this is done is by drive-by shootings in the most illiquid period of time, where any trader who would have done that, David, would be fired and shot, and most likely not in that order, if it were done for real benefit, and it just isn't. So I don't know. The trend hasn't changed. Really, the trend will not change until central banks stop buying gold, and they're not doing that. And this is just a breather. You also have the October sell season, where it's the end of the fiscal calendar. You got hedge funds need to balance their books and book their losses or their gains. You have November being the buy season, where now they come in with fresh capital and getting ready to redeploy it. So there's a lot at play here. But in the end, who benefits? The ones that were able to drive the price down and cover stale shorts, that in an environment where we see a lot of standing for delivery, which is an environment that makes having rehypothecated positions very dangerous.
Markets often whisper their truth long before the headlines catch up. Beneath the calm surface of falling spot prices lies a quiet scramble for what's real metal that can't be printed or defaulted on. The contrast between empty vault liquidity and overflowing retail demand isn't random. It's the signal of a system stretched too thin. Every time a contract is settled with metal instead of paper, the illusion of abundance weakens. And when large players start paying attention to delivery rather than derivatives, it means confidence in the structure itself is fading. Silver's current lull isn't a sign of disinterest, it's the deep breath before the next sprint. While traders chase short-term moves, those who understand the longer game see these shakeouts for what they are: clearance sales on tangible value before reality resets the scoreboard. So the question now is, when the dam of paper claims finally bursts, how many will still have the patience and the mettle to stand on the other side of it? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.